Welcome back to the deep dive. Today we're opening up a treasure chest of sources that I think promises not only to inform you, but to fundamentally empower you.
Yeah, that's really the goal today.
Yeah.
Because for decades, the financial world has, well, it's successfully perpetuated a myth,
A very powerful myth.
incredibly powerful, that investing is some kind of dark art, accessible only to an elite few.
And this deep dive is all about tearing that mythology down. We want to expose the simple, common sense truths that are kind of hidden beneath all the jargon.
Our mission today is centered on the investment philosophy of one of the greatest money managers of all time, Peter Lynch. And when you look at his success, I mean, it's a record that remains essentially unmatched. You might assume he was this complex genius wielding proprietary algorithms.
Right, some kind of quant wizard locked in a room.
Exactly. But our sources, they reveal a completely different story. It's a classic David versus Goliath narrative. Lynch proved that the average observant person possesses an inherent, a structural advantage over the professional Wall Street expert.
And that's what we're giving you today, the blueprint to recognize and then, activate that advantage in your own life.
That's the plan.
Okay, let's unpack this and jump right into the core contrast. We've got sources discussing his background, his explosive run at the Magellan Fund and the psychological toolkit he left behind. But we have to start by confronting the biggest lie the financial machine tells us.
The prevailing myth, like you said, is that financial success requires you to be initiated into the club.
Right.
You have to have an Ivy League degree, you have to be physically on a trading floor, or at the very least, you need a direct feed into the most complex, expensive technology available.
The whole infrastructure it's designed to make the average person feel small.
It is. It's designed to convince the retail investor that you are dumb money, that you're just incapable of navigating the complexity of the markets on your own.
And it's a remarkably effective lie, isn't it? I mean, precisely because it is so expensive to maintain. It keeps smart, educated people on the sidelines, earning nothing in savings accounts.
Or it pushes them into these overly complicated, high-fee investment products they don't truly understand. The lie is the barrier. It's the gatekeeper.
But when our sources introduce the actual Peter Lynch, the person behind this whole philosophy, that image of the quant wizard, it just shatters instantly.
It truly does. We picture the legendary money manager as someone who, specialized in stochastic calculus or high-level economic modeling. That's the modern expectation.
Sure.
But the shocking grounding truth about Peter Lynch is that he didn't study advanced mathematics. His university background was in history and philosophy.
That is such a crucial detail. When you think about those disciplines, history and philosophy, they're rooted in pattern recognition, in understanding human motivation, assessing narrative credibility.
And applying critical thought, not in rigid quantification.
Exactly. Lynch's foundational education taught him to understand people, not just numbers. And that immediately challenges the idea that investing requires the kind of specialized, high-level technical training that Wall Street tries to monopolize.
It completely flips the script. So if his education wasn't the secret weapon, what was? It wasn't proprietary data feeds or a Bloomberg terminal that costs more than most people's annual salary.
It was simple, daily observation.
That's it. The sources detail his analysis of common consumer goods. What was selling? He was looking at things like the success of a specific brand of pantyhose, or whether a particular chain of coffee shops was drawing lines around the block.
A cup of coffee and a pair of pantyhose. I mean, that combination perfectly encapsulates the core thesis we're pursuing today, doesn't it?
It's perfect. Lynch proved that what he famously called Main Street could, and absolutely did, beat Wall Street.
Because Main Street lives in the real economy. It sees trends, products, services succeeding or failing in real life long before those indicators show up, filtered and abstracted in some quarterly financial report.
A report analyzed by analysts in downtown skyscrapers who are completely detached from that reality.
So think about the implication for you, the listener. If the biggest barrier to success isn't market knowledge, but rather confidence and common sense, then your daily life becomes this massive, untapped asset.
Lynch realized that because professionals are institutionally confined, geographically, mentally, and professionally, they're often the last people to recognize a grassroots trend.
Exactly. This entire deep dive is your permission slip. It's reinforcing Lynch's belief that the amateur investor, the person living their life, whether they are a doctor, a teacher, a technician, a parent, possesses a unique informational edge that the institutional pros just cannot replicate.
So let's start by understanding how he got that foundational insight. Where did it all begin?
To understand where this revolutionary mindset, this belief in common sense over complexity came from, we have to look closely at his origin story. And it's not a glamorous tale of, trust funds and private schools. It's a story grounded in personal tragedy and the necessity of work.
That humble beginning was absolutely formative. It provided the necessary contrast to the world he would later conquer. Our sources highlight that when Peter was just 10 years old, his father died from cancer.
Just 10.
Yeah. And this was not only a profound emotional loss, but an economic one. It forced him to mature very quickly and find work early to help support his mother and his family. He learned the value of a dollar and the necessity of hustle at a really young age.
And the job he found, it wasn't an internship at Goldman Sachs or something like that. He got a job at the Braeburn Country Club outside of Boston as a caddy.
We really need to pause and visualize that setting because it provides the critical grounding insight that would shape his entire career. It's the whole ballgame right there on the golf course.
Paint that picture for us.
Okay, so imagine young Peter Lynch, maybe 11 or 12 years old, carrying 2 heavy golf bags up the 18th fairway on a hot summer afternoon. And who are those bags for?
The titans of industry.
Exactly. The presidents of the biggest banks, the heads of mutual funds, the CEOs of major corporations, the supposed elite, the true masters of the universe. He wasn't in their offices. He was on their turf, in their element, observing them when their guard was completely down.
And the crucial insight wasn't just seeing them, it was listening to their unguarded conversations. This young caddy was privy to the raw emotional dynamics of investing.
That's the key. He heard the swagger and the bragging about their latest sure thing stock pick on the fairway when things were going great, when the martinis were flowing and they felt infallible.
But more importantly, he heard the other side of it.
So much more importantly, he heard the panic. He heard the frustration, the fear, the indecision when they were in the rough or after a bad quarter or facing just a small market correction. He heard them rationalize panic selling or stubbornly holding on to a loser because they just couldn't bear to admit they were wrong.
What a profound education. At 14, he's realizing that the supposed masters of the universe weren't gods of finance.
Not at all. They were just people, subject to the exact same irrational human emotions, greed, fear, overconfidence, that afflict the smallest retail investor.
That demystification of the financial elite was the foundation of his career. If the pros were making mistakes based on emotion, then the game wasn't about being smarter or having more complex tools.
No, it was about being more disciplined and having better judgment.
It allowed him to step back and conclude that investing wasn't some kind of precise, predictable engineering field or a hard science like physics.
He famously encapsulated this realization from the fairway. He said, and this is a direct quote, "Investing is an art, not a science. People who've been trained to rigidly quantify everything have a disadvantage."
Let's just dwell on that for a moment because it challenges the fundamental orientation of modern finance. When you treat investing as a hard science, you're seeking perfection, right? You want certainty, quantifiable rules.
You want a formula that guarantees success. You rely on models, historical regressions, and inputs that promise precision.
But Lynch saw that approach could actually be blinding. It can make you miss the simple, obvious story that's unfolding right in front of your eyes.
The art of investing relies on judgment, on synthesizing disparate pieces of information, a feeling about a product, a trend in your neighborhood, a conversation at the clinic, and then applying common sense.
So too much rigid quantification trains you to ignore the qualitative evidence.
Exactly. It focuses you on the numbers from the past rather than the narrative of the future. The caddy's education taught him that a keen eye and disciplined qualitative judgment were far more valuable than a complex algorithm. And that right there is why this story is so empowering for the person listening right now.
You don't need a PhD in financial engineering.
You just need to be a great, consistent observer of the world around you. And that common sense approach prepared him perfectly for his greatest challenge.
Okay, let's fast forward a couple of decades to 1977. Peter Lynch is given the keys to the Fidelity and Magellan Fund. To fully appreciate the scale of what people call the Magellan miracle, we first have to understand the starting point.
The setup is absolutely essential for context. Magellan at the time was not the superstar fund everyone knows today. Our sources describe it as tiny, obscure, and nearly forgotten. When Lynch took over, it had a mere $18 million in assets.
$18 million. Just to put that in perspective, today that might fund a small cap startup or like a single luxury condo building in New York.
It was a minnow. A minnow in the ocean of institutional money.
And what he accomplished over the next 13 years, from 1977 to 1990, is just statistically mind-boggling. It cemented his place as a legend. We need to hit these numbers and let them sink in, because they illustrate not just success, but absolute dominance.
Okay, so the headline number. He averaged a 29.2% annual return.
Averaging 29.2% over a single spectacular year is incredible.
Right, but sustaining that average over 13 years it's unprecedented. To provide some necessary context for you, the listener, the historical average return for the S&P 500 is typically cited around 10% annually, maybe a bit higher, but nowhere near 29%.
So he was nearly tripling the average market return year after year after year. He was leveraging the power of compounding to an almost unimaginable degree.
And that compounding power is where the miracle truly manifests. Let's look at the math provided in our sources because it quantifies this performance beautifully. If you had put a simple, non-life-changing amount, say $1,000 into the Magellan Fund the day you took over,
Okay.
by the time he retired, that investment would have grown to approximately $28,000.
$28,000 from $1,000.
Now, compare that $28,000 outcome to what a typical investor would have achieved by simply putting that $1,000 into a passive index fund tracking the S&P 500 during the same period.
Okay, so just buying the market.
Just buying the market. That average market return would have turned your $1,000 into maybe, what, $4,500 or $5,000.
Yeah.
Lynch's methodology, his art of observation and discipline, delivered a multiple of 4 to 6 times better than simply betting on the entire market. That transformation from $1,000 to $28,000 highlights the sheer explosive impact of that sustained, outsized growth.
And crucially, this wasn't luck. It was a repeatable philosophy. He didn't just beat the market, he dominated it. He outperformed the S&P 500 in 11 out of those 13 years.
11 out of 13. That consistency demonstrates a philosophy that endures, rather than just a streak of good fortune tied to a specific economic cycle.
So what was the final tally? Where did the fund end up?
The final tally is almost unbelievable, provided a capstone to the scale of the achievement. That tiny, obscure fund, starting at $18 million.
Right.
It ballooned under his stewardship to an astonishing $14 billion.
$14 billion.
With a B.
With a B. That kind of asset growth, while maintaining elite performance, is a feat rarely, if ever, seen again in the fund management world. It requires an ability to find successful investments across the entire market spectrum, which leads to his famous nickname.
He was dubbed the chameleon.
The chameleon. And this is an important detail we can't overlook because people often oversimplify his method.
Right. They think he just bought stuff he saw at the mall. Exactly. But Lynch didn't only buy simple, retail-facing stocks. Our sources confirm he was buying everything. Boring, stable companies like utilities, turning around companies, cyclicals, and fast-growing companies in technology or retail. If the company had a compelling story and strong fundamentals, he was interested, regardless of the sector.
Understanding the chameleon part of his nature is crucial. If you only buy high-growth tech, you get hammered in a downturn.
And if you only buy utilities, you miss out on massive growth opportunities. Lynch mastered the ability to analyze and invest across all 6 of his defined investment categories. But regardless of the category, he was always looking for one specific transformative thing.
And this is the term he coined that has become essential investor slang.
The 10-bagger.
The 10-bagger.
This is the jargon alert every investor needs to know. It's simply defined as a stock that multiplies your initial investment by 10x return. The term comes from baseball, where a 4-base hit is a 4-bagger.
A 10-bagger in investing means turning $1,000 into $10,000, or $10,000 into $100,000.
And Lynch's philosophy centered on the fact that you only need a few 10-baggers over your lifetime to make your entire portfolio overwhelmingly successful. You don't need to be right 100 times. You just need to find the 1 or 2 that go up 1,000%.
And the genius of it is that he found those massive winners not by running complex Monte Carlo simulations, but by observing the world around him, which leads us directly to the core of his actionable advice and also his most frequently misinterpreted teaching.
If Peter Lynch has one famous quote, it's, "Invest in what you know." And this is the point where we need to apply the most important correction in this entire deep dive.
Because this advice is almost universally misunderstood.
And often used incorrectly to justify laziness.
Absolutely. The shallow, dangerous interpretation, the one Lynch spent years trying to correct, is that immediate gut reaction. I really like this coffee shops brand, they make a great latte, therefore I'm buying the stock tomorrow.
He absolutely hated that. Liking a store or a product or a service is only the starting point. It is merely a reason to research the company, not an automatic reason to buy it.
It's a lead.
It's a lead. You're identifying a promising candidate, a potential 10-bagger. But you still have to do the due diligence. You must look at the financials, the debt, the competition, the profit margins, the quality of the management. Observation triggers research. It never, ever replaces it.
So here is the real insight, the core philosophy that truly empowers the amateur investor. Your daily life is a powerful proprietary screening tool.
That's it. The world outside the trading desk provides endless, free, early signals, and this is exactly where the amateur beats the professional.
Let's use the specific illustrative examples from the sources to hammer this home and show you where your advantage lies.
Okay. Consider a new consumer trend, like an emerging sneaker brand or a unique type of energy drink that suddenly dominates the high school crowd. Who is going to see that trend exploding in popularity first?
It's definitely not the Wall Street analyst. That person is isolated in a skyscraper 50 floors above the street, probably only leaving to go to the company gym or some high-end restaurant. They only wear bespoke dress shoes and see trends filtered through dry data.
Precisely. The people who see the trend in volume and velocity are the parents shopping for their children, the mall managers, the teenagers themselves, or the store clerks. They are witnessing the shift. The old brands being discarded, the new brand becoming ubiquitous, months before the analyst sees the sales figures show up in a quarterly report that just confirms what was already happening on the ground.
That's your edge.
And the advantage extends far beyond retail. Think about a specific professional field. If you are a dentist, you know exactly which new dental implant technology or specialty rinse is truly effective and which ones are junk.
Because you're using them every single day.
Exactly. If you're a mechanical engineer, you know which industrial pump manufacturer is cutting corners and which one is building a vastly superior product that will last years longer.
Lynch called this phenomenon local knowledge.
Local knowledge. The hyper-specific, actionable insight the listener possesses due to their profession, their hobbies, or their geography. Wall Street analysts are generalists. They cover dozens of companies and try to understand everything abstractly. You are the specialist, the on-the-ground expert in your specific narrow domain.
And that local knowledge gives you a temporal advantage. The ability to spot a 10-bagger candidate months or even years before it becomes widely known in the financial press.
That's the equalizer. And it leads us directly to the next layer of Lynch's critique. Why are the professionals, the supposedly smart people with all the money and tools, so consistently blind to these obvious real-world trends?
What's holding them back?
Our sources detail two core institutional handcuffs that prevent professionals from using common sense and spotting these obvious trends. These handcuffs are about incentives and survival, and they create a profound structural weakness that the amateur doesn't have.
What's the first one?
The first one, and perhaps the most crippling, is career risk. Fund managers are working with OPM other people's money. If they make a safe, conventional, blue-chip pick that everyone else owns, like a giant pharmaceutical company or a massive bank, and the stock goes down,
They can just shrug.
they can shrug. They can say, well, everyone was wrong. It was market-wide failure. Their job is safe.
This is where Lynch drops that golden, devastating soundbite that perfectly mocks the conformity of the industry.
He says, you'll never lose your job losing your client's money in IBM.
I mean, just think about that. He's saying that institutional safety trumps client returns.
It's all about covering your own back. They would rather buy guaranteed safe, mediocre stocks that moves with the herd than risk their career on an unknown, potentially brilliant 10-bagger candidate they discovered using their own local knowledge.
Let's really drill down into that hypothetical. Imagine two scenarios for a fund manager. In scenario A, the manager buys a small, unheard-of company that makes superior industrial cleaning chemicals that you, the listener, spotted at your job. It drops 20%.
The manager is grilled. They're criticized, maybe even fired for making an unconventional, weird pick.
Okay, now scenario B. The manager buys a massive consensus stock, maybe a century-old energy company. It drops 20% because the entire sector is struggling.
The manager just says, well, so did all my competitors. It was macroeconomic. The board shrugs. The institutional imperative is to conform, not to outperform wildly through independent thought. They herd together to avoid individual blame.
But the amateur, the individual listener, you don't have a boss to answer to about your personal brokerage account. You can buy that weird little local company you truly believe in because your career isn't on the line.
That freedom, that ability to bet on conviction, is an enormous structural advantage that Wall Street simply cannot afford to utilize.
Okay, so that's career risk. What's the second handcuff?
The second handcuff is short-termism. Professional fund managers are constantly scrutinized. They are graded every 90 days. They live and die by quarterly performance reviews because that's how institutional money allocates capital.
So they're always thinking about the next 3 months, not the next 3 years.
Exactly. This rigid, short-term focus forces them to prioritize immediate results over long-term value.
This is a classic conflict. If a fund manager buys a truly great company, a future 10-bagger, but that company experiences a temporary setback and the stock drops 10% in a single quarter.
The manager might be forced to sell it even if the business fundamentals are completely intact. Why? To look good for their boss, to prevent institutional clients from panicking and pulling their assets, or just to stop the short-term noise.
They sacrifice long-term value for short-term optics.
Whereas Lynch's philosophy requires a minimum 3 to 5 year time horizon. The amateur answers to no one but themselves. If the story is still sound, if that sneaker brand is still exploding, or that industrial cleaner is still gaining market share, you can hold that stock for 5 years, 10 years, or longer.
You can let the true growth story unfold.
And that patience is perhaps the single greatest and easiest to utilize advantage the amateur holds over the professional.
So finding the right company, the potential 10-bagger, that's only half the battle. The other, and I'd argue harder, half is handling the inevitable emotional roller coaster that follows. Once you own a stock, how do you handle the volatility, the fear, and that human urge to tinker?
This is where Lynch shifts entirely from strategy to psychology. And he was a master of the intuitive, providing these beautiful metaphors that explain exactly why investors sabotage themselves even when they've done the research right.
The most famous one directly addresses poor reactive portfolio management.
He said, selling your winners and holding your losers is like cutting the flowers and watering the weeds.
It's a perfect yet brutally honest summation of the most common investor mistake.
It perfectly captures the psychological trap. We've all experienced it. When a stock we own goes up 20%, that's the flower. We immediately feel a wave of anxiety thinking, oh no, I better take this profit before it disappears.
Right, that fear of losing the gain causes us to sell prematurely.
And we limit our returns on our best ideas. We cut the flower before it can fully bloom into a 10-bagger.
Meanwhile, another stock, the wheat, is down 20%. And our ego kicks in.
Oh, the ego. We refuse to sell, not because the company is fundamentally sound, but because we hope that maybe, just maybe, it will return to our purchase price so we can break even and minimize that feeling of being wrong.
We hold on to the bad idea. We water the weeds.
And this destructive behavior ensures you maximize your losses by holding the bad investment and minimize your gains by selling the winners too soon. It is the exact opposite behavior needed to achieve the kind of returns Lynch delivered.
And the reason this metaphor resonated so deeply is that it describes a near-universal human tendency, the fear of regret and the avoidance of admitting failure.
Absolutely. It's so universal that even Warren Buffett, the ultimate master of long-term common sense investing, loved the line so much he actually called Lynch to ask permission to use it in his own letters and speeches.
Wow. That level of endorsement, that speaks volumes about the universality of this emotional trap.
So the core lesson is discipline, rooted in rationality. If the company's story is still sound, if its earnings are growing, and the underlying business fundamentals are intact, you must hold it, even when the market is scared and the stock price is dipping.
And that requires tremendous emotional fortitude. It's why Lynch made that distinction between intellect and emotional capacity.
He concluded that for long-term success, the most important organ in the stock market isn't the brain, it's the stomach.
The stomach.
The brain gets you to the starting line by conducting the research, but the stomach determines whether you finish the race. Once volatility hits, once the news is scary, you need that gut-level discipline, the strong stomach, to withstand the fear and the noise and prevent yourself from cutting the flowers.
But Lynch wasn't just a philosopher, he was a practical man. He knew that simply telling people to have a strong stomach wasn't enough to combat primal fear.
Right. So he offered a mandatory, actionable ritual to inoculate investors against market panic.
This is the practical core of his psychological toolkit, the 2-minute monologue. He insisted that before you buy any stock, you perform this mandatory pre-buy ritual. It forces rationality when you are calm, so you can draw on it when the market is chaotic.
The ritual is so simple. You have to physically write down a 2-minute monologue addressing 2 specific points. First, I am buying this because...
This forces you to detail the complete investment thesis, the reason, the story, the competitive advantage, the growth drivers, not just it's going up.
No, it has to be concrete. I believe this company's patented technology will reduce shipping costs by 30% over the next 5 years, giving it a permanent edge over competitors A and B. Something real.
And second, the truly critical part, I will sell if.
This defines the exit strategy, the specific measurable condition under which the original thesis has failed. And importantly, this condition cannot be if the stock goes down 10%.
That's just price movement, not a fundamental change.
Right. It has to be a fundamental failure. Like, I will sell if the competitor launches an identical product that negates the patent advantage. Or, I will sell if the CEO I trust resigns and a known corporate raider takes over.
And the profound beauty of this ritual is revealed when things go wrong, which they inevitably will.
That's when you need it. When the news cycle is full of panic, a geopolitical crisis, an interest rate shock, a headline screaming recession, that's when you feel the overwhelming urge to hit the sell button.
And Lynch instructs the listener to pull out that piece of paper and read the monologue.
And if the original reason for buying, the company's actual fundamentals, its market position, its earnings growth, is still true, then you ignore the noise and you hold. You don't let temporary fear override the reasoned analysis you conducted when you were calm. The monologue is your anchor to rationality.
But conversely, if you read the monologue and realize, wait, the reason I bought this company, that superior management team, is gone, and they just announced massive share dilution, then the thesis has failed.
And you sell immediately, regardless of whether you're up or down. The monologue is your cold, hard contract with yourself. It ensures you act on facts, not on fear.
Okay, we've covered the history, the record, and the emotional discipline required for success. But now we have to address the inevitable skepticism. I mean, this philosophy was forged in the 1980s. Does this common sense wisdom work today, in 2025, in the age of high-frequency trading, meme stocks, crypto, and complex AI algorithms?
Our sources suggest that Lynch's answer is not just yes, but perhaps more yes than ever before.
Really? Why more?
Because the core fundamentals of human behavior, common sense, and compounding returns have not changed, even if the technology around the market has. In fact, the local knowledge advantage is arguably greater now because professional analysts are often overwhelmed by complexity they don't truly grasp.
And to combat that inherent complexity, Lynch advocated for a deep, abiding love for the boring stock. This is another key counterintuitive piece of his advice.
Oh yeah. He famously preferred industries that no one paid attention to, the things that elicit a yawn at a cocktail party.
Like what?
The sources specifically cite his preference for businesses like funeral homes and grease removal companies over the hot tech stocks of his day.
Funeral homes and grease removal. So glamorous.
But his rationale is sound and timeless, and it cuts straight through the hype. In boring industries, the competition is usually low. The barriers to entry can be high because the work is unglamorous or requires specific equipment.
So if you are running the best regional funeral home business or the most efficient, compliant waste management service, you can often maintain incredibly stable, predictable profit margins without the cutthroat innovation required in, say, the AI chip manufacturing sector.
And stable profits year after year means stable, successful investments, the kind that silently compound returns into 10-baggers without all the drama.
Today, everyone in the institutional sphere is chasing the next massive breakthrough in AI or the new disruptive software. The competition is intense, the development cycles are brutal,
and the valuations are often astronomical, built entirely on projected future earnings that might never materialize. It's a high-risk game of intellectual one-upmanship.
Lynch warns directly against that frenzy. He explicitly stated that investors must be extremely careful with what they don't truly understand.
If you're buying into a complex AI chip company simply because it's hot and everyone else is talking about it, and you cannot articulate its core competitive advantage in simple terms, you are simply gambling. You're not investing.
This brings us back to his most simple, elegant test for complexity, which is essential for you to adopt right now. It's the rule of the 10-year-old.
He warns that if you cannot explain the business, where it makes its money, who its customers are, and why it's better than its competition, to a 10-year-old in 2 minutes, you shouldn't own it.
That rule forces intellectual humility and honesty. Let's try it right now. How would you, based on what we see in the sources about current complexity, explain high-frequency trading or the process of mining cryptocurrency to a 10-year-old using the 2-minute rule?
Pauses. That's a fantastic test. Okay, if I try to explain high-frequency trading, I immediately start hedging. I'd have to say, well, it involves supercomputers near the exchange, using proprietary fiber optic lines to execute tiny trades fractions of a second faster than anyone else, exploiting microprice differences.
And I'm already lost.
Exactly. That's 3 lines in, and I've already used jargon like proprietary, exchange, and microprice differences. A 10-year-old would be lost, and frankly, most amateur investors would be lost too.
The fact that the explanation relies on jargon, complexity, or unseen mechanisms means you don't have a grasp on the actual business advantage.
Now compare that to explaining a funeral home. This company helps families bury or cremate their loved ones. It has fixed costs, it's a necessary service, and people don't shop around much, so it makes stable money. Simple, defensible, and understandable.
The 10-year-old rule ensures you truly grasp where the company's cash flow comes from and why it is defensible. If you start saying things like, well, it's complicated, involving distributed ledger technology and proprietary APIs that leverage cloud-based synergies.
That is a massive red flag. You don't own a company, you own jargon. And jargon collapses very quickly when the market gets scared.
And the beautiful, grounding reassurance in the modern age is this. Whether you are investing in 1980 or 2025, the math of compounding remains constant, and patience pays off.
That 29.2% annual return he achieved wasn't done with day trading or exploiting microprice differences. It was done with deep research and long-term commitment. Time remains your greatest ally, provided you buy solid, understandable businesses.
As we wrap up this deep dive, it's worth reflecting on the totality of Peter Lynch's legacy, especially his personal choices.
Yeah, he retired in 1990, walking away from managing $14 billion in assets at the absolute peak of his career and his physical health.
That decision, it just underscores the entire philosophy, doesn't it? He retired early, citing a desire to spend more time with his family. He proved that winning in the market doesn't mean you have to become a perpetual Wall Street shark consumed by quarterly results and endless complexity.
You just need common sense, courage, the willingness to do basic research, and the confidence to trust your own eyes. His story provides the ultimate proof that the institutional machine, despite all its complexity and overwhelming volume of information, is vulnerable to the quiet observation and disciplined common sense of the individual.
Lynch's career is the ultimate blueprint for the amateur investor, a powerful permission slip that says, your perspective is not only valid, it is often superior.
So here is the challenge, the empowering task we have for you, the listener, based entirely on activating Lynch's local knowledge principle this week.
What's the first step?
The first step is counterintuitive and it requires discipline. Do not open your brokerage app this week.
Don't open it at all.
At all. Resist the urge to check the ticker tape, look at the news, or make a trade based on fear or excitement. Shut it down.
Instead, open your eyes and engage your local knowledge. Walk through a local grocery store. Observe the new software or tools your company is adopting at work. Or simply look at the specialized cleaning products or industrial equipment being used in your neighborhood.
The goal is simple. Find just one company, one service, one product, one brand that you genuinely think is doing a great job, that you see gaining popularity, or that you see is solving a mundane problem beautifully and efficiently.
And then simply look them up.
That's it. Find their website, read their About Us page and their latest financial press release. That's all.
That is step one, activating your local knowledge and beginning the research process. Transforming yourself from a passive consumer of financial news into an active investigator of business excellence.
Just like the caddy who listened to the Titans on the fairway.
And finally, a provocative thought to mull over, one that ties back to Lynch retiring at the height of his success.
Peter Lynch, the man who proved you could turn $18 million into $14 billion, ultimately chose to prioritize his family and his life over accumulating more zeros on a balance sheet. Consider what true wealth means to you beyond the investment portfolio. Defining that is perhaps the most important investment decision you will ever make.